In 2007, Warren Buffett made a $1 million bet. He bet that a simple, boring index fund would beat any group of hand-picked hedge funds over 10 years. A hedge fund manager named Ted Sides took the bet. He chose 5 of the best hedge funds in the world. Funds managed by highly paid professionals, people with Ivy League degrees, decades of experience, and access to the best market research money can buy. 10 years later, the index fund won by a lot. The index fund returned 125.8%. The best hedge fund in the group returned 87.7%. The worst returned just 2.8%. The professionals lost to a fund that nobody manages, a fund that simply tracks the market and gets out of the way. Today, I'm going to show you exactly why that happens and exactly how you can use this to build real wealth. Stay with me, because the fee number in section 3 is going to make you angry. Welcome to Money Explained in Minute. By the end of today, you will understand what index funds are, why they consistently beat professional fund managers, and exactly how to start using them this week. Let us get into it. Most people have heard of the stock market, but very few understand what they are actually buying when they invest in it. Here is the simplest way to think about it. Imagine the entire stock market as a pizza. Each slice is a different company. Apple is one slice. Amazon is another, Microsoft, Tesla, and so on. When you buy an index fund, you are not picking one slice. You are buying the whole pizza, every company in the index, all at once, in one purchase. An index is simply a list of companies that meet certain criteria. The most famous is the S&P 500. That is a list of the 500 largest companies in the United States. When you buy an S&P 500 index fund, you own a tiny piece of all 500 of those companies simultaneously. Apple, Microsoft, Google, Amazon, Berkshire, Hathaway, all of them with one simple purchase. Now, here is why this matters. Individual companies can go bankrupt. Individual companies can collapse overnight. But 500 companies do not all collapse at the same time. When some fall, others rise. And over the long term, the overall market has always gone up. Always. In every rolling 20-year period in modern market history, the S&P 500 has delivered an average return of around 10% per year over the last 50 years. That includes crashes, recessions, 2 world wars worth of global crises. Through all of it, the long-term average is 10% per year, and an index fund captures that return almost perfectly, because it does not try to do anything clever. It simply holds the market, all of it, forever. So, if the market returns 10% per year on average, why do so many people still try to beat it? And more importantly, why do they almost always fail? This is where it gets fascinating. Active fund managers are paid to do one thing. Pick the stocks that will go up more than the market. Sell the ones they think will go down. Buy before the rise. Sell before the fall. It sounds logical. If you are smart enough, surely you can do this. Here is the data. Over any 10-year period, around 90% of active fund managers underperform a simple index fund. 90%. Over 20 years, that number rises to over 95%, meaning only 5 in every 100 professional fund managers beat a basic index fund over a 20-year period. And even those 5, researchers cannot tell if it was skill or luck. Why does this happen? Reason 1. The market is incredibly efficient. Every piece of information about a company is already priced in by the time you read it. Millions of buyers and sellers are acting on the same information every second. For you to beat the market, you need to know something that millions of other professionals do not know. Almost nobody can do that consistently. Reason 2, the cost problem. Every time an active manager buys or sells a stock, there are transaction costs. Every trade, every switch, every rebalance, Those costs add up and eat directly into your returns. An active fund that delivers 10% gross returns might only give you 8% after costs. Meanwhile, the index fund delivers 9.8% because it barely trades at all. Over 20 years, that 2% difference is enormous. We will show you exactly how enormous in Section 3. Reason 3. The paradox of skill. The better the professionals get at finding undervalued stocks, the harder it becomes for any single manager to maintain an edge. When everyone is smart, nobody has an advantage, and the index, by owning everything, wins by default. Now, here is the section that is going to make you angry, and it should, because this is the number that most financial institutions hope you never actually calculate. It is called the expense ratio. That is the annual fee charged by a fund to manage your money. For an active fund, this is typically between 1 and 2% per year. For an index fund, this is typically between 0.03 and 0.2% per year. 1% versus 0.03%. That does not sound like much, does it? Let us do the maths. You invest $10,000. Both funds deliver the same 10% gross return every year. After 30 years in the index fund at 0.03% fees, you have $174,000. After 30 years in the active fund at 1% fees, you have $132,000. The fee difference cost you $42,000 on a $10,000 investment. The fund manager did not earn that $42,000, they simply charged it every year automatically, whether the fund went up or down. Now scale this to a realistic retirement portfolio, someone investing $500 a month for 30 years at 1% fees versus 0.03%. The fee difference over 30 years is over $200,000. $200,000 gone. Not lost in the market, not from bad decisions, simply paid to a fund manager in annual fees for a fund that probably underperformed the index anyway. This is why Warren Buffett does not just recommend index funds. He instructs that 90% of the money left to his wife after he dies should be placed in a simple, low-cost S&P 500 index fund. The most successful investor of the 20th century chose not to actively manage his own legacy. He chose the index. Before we talk about how to get started, there is one thing that confuses almost everyone: the difference between an index fund and an ETF. You have probably seen both terms and wondered if they are the same thing. The short answer, almost, but not quite. An index fund and an ETF can both track the same index. For example, both can track the S&P 500. The difference is in how you buy them. An index fund is bought directly from the fund company. You invest a fixed dollar amount, say $100 a month. The fund buys you fractional shares automatically. An ETF, which stands for Exchange Traded Fund, is bought and sold on the stock market like an individual share. You buy whole or fractional shares at the current market price. Which one is better for you? If you are investing a fixed amount every month automatically, a traditional index fund is often simpler. If you want more flexibility to buy and sell throughout the day, or if your platform only offers ETFs, an ETF works equally well. The most important thing is this: both can track the same index. Both have low fees. Both work. The vehicle matters far less than the destination, and the destination is owning the whole market at the lowest possible cost. So you are convinced. You want to invest in index funds. Where do you start? There are 4 things you need to look at when choosing an index fund. Number 1, which index does it track? The S&P 500 gives you 500 large US companies. A total world index fund gives you exposure to thousands of companies globally. A total US market fund includes small and mid-size US companies too. For most beginners, a broad global index or S&P 500 is the best starting point. Number 2, what is the expense ratio? As we showed in section 3, fees compound just like returns. Look for an expense ratio below 0.2% per year. The best ones are below 0.05%. Anything above 0.5% is hard to justify for a passive index fund. Number 3, who runs it? Vanguard, Fidelity, BlackRock, these are the biggest and most established. They are also the cheapest. You do not need to go with a smaller provider to get a better deal. The biggest players are the cheapest because they have the most assets. Number 4. Which platform will you use? In the US, Fidelity, Vanguard, and Schwab all offer zero-fee index funds. In the UK, Vanguard Investor, Hargreaves Lansdown, and Invest Engine are popular. The key is choosing a regulated, established platform with low or zero transaction fees and low custody fees. You want the money working for you, not paying fees to hold the money. Here is your 5-step index fund action plan. This week, zero cost, works at any income level in any country. Step 1, check if your employer offers a pension or retirement account with index fund options. If they do, and they match contributions, this is your highest priority investment. A 100% employer match is a 100% instant return. Nothing beats it. Do this first. Step 2, open an investment account on a regulated platform. In the US, this might be a Roth IRA or brokerage account. In the UK, this might be a stocks and shares ISA. Use a tax-advantaged account wherever possible. The tax saving alone can add tens of thousands over a lifetime. Step 3. Choose one broad market index fund. Do not overthink this. A global index fund or S&P 500 fund from Vanguard, Fidelity, or BlackRock with an expense ratio below 0.2%. That is your fund. That is all you need. Step 4. Set up an automatic monthly contribution. Even if it is $20, even if it is $50, the amount is less important than the habit. Automate it. Remove the decision. Let compound interest start working. Step 5. Do not touch it. When markets fall, and they will, do not sell. When markets crash, and they will, do not sell. Every market crash in history has been followed by a recovery. Every single one. The people who sold during the crash locked in their losses. The people who held, and especially the ones who kept buying, recovered and grew beyond the crash level. Your only job is to keep contributing and stay out of the way. Let us bring everything together. An index fund owns the whole market. It does not try to beat the market. It simply is the market. 90% of professional managers cannot beat it over 10 years. 95% cannot beat it over 20 years. The fee difference between an index fund and an active fund can cost you over $200,000 over a working lifetime. Warren Buffett, the greatest investor of the last century, chose to leave his estate in an S&P 500 index fund, not because he could not find a good active manager, because he knew that over time, the index wins. Your action plan. 5 steps this week. 1. Check your employer pension. 2. Open a tax-advantaged investment account. 3. Choose one broad market index fund. 4. Set up automatic monthly contributions. 5. Do not touch it. The moment this video ends, do one thing. Find out what funds your employer pension offers. If they match contributions, increase yours to the maximum match. That is a 100% instant return on your money. Nothing in investing beats that. If this gave you value, subscribe to Money Explained in Minutes. Every week, one important money concept made as simple as possible. No jargon, no lectures, just clarity. drop a comment below. Do you already invest in index funds? I read every single one. Next week, we are going to look at how to build your first investment portfolio, how to combine index funds, bonds, and other assets to match your personal risk level and goals. Subscribe so you do not miss it. Money explained in minutes. Understand money. Build wealth. See you next week.